Welcome back to our special end-of-year edition of Deal Book, and I've got with me still Simon Siegel from Deal Reporter, Tony Damian, partner at Herbert Smith Freehills, and we now take you to Perth to join the discussion with Charles Fear, the chairman of Argonaut Corporate Advisory, boutique specialists in the West. And now, warm welcome into the show, Charles. Can we just, I suppose, and also let me remind you, we've got John O'Sullivan, the chairman of Credit Suisse, who's in our Sydney CBD studio. But I want to bring Charles into this now from the West. And Charles, welcome to the show. For you, what's 2014 stand for on reflection? Resources, developments, of course, we've not really got into China yet, but does that basically topple everything else as the most important issue as far as the FTA and the commodity story that's gone with it?
Has seen the nadir in the commodities cycle. We've seen a lot of activity, particularly in the resources sector, in M&A. I think key themes in that regard have been large company disposals of assets and acquisitions of those assets by mid-cap miners. Some of the more notable ones have been Barrick Gold sold its gold assets in the West here to Northern Star, $100 million deal, significant company maker for Northern Star. Norilsk again sold its gold assets in Australia to Saracen, company maker for them. BHP sold Jimblebar, and given the iron ore price, was probably a masterstroke. I think perhaps the biggest transaction we've seen with large companies disposing of assets, so these are asset sales as opposed to public company M&A, is the Apache sale of their Australian oil and gas assets to Woodside.
Which came pretty late in the piece, didn't it, all things considered. Just on the first point, because we had a bit of an issue with the audio, but was I right in hearing you say there, Charles, that you believe we're at the nadir of the commodity cycle? You don't think it's going to go lower? You think we've bottomed? Just want to clarify that.
We're at the bottom, or fairly close there too. I can tell you 2014 was not a good time to be a boutique resource and resource services investment banking company. We certainly experienced some tough times. But usually, in my experience, and I've been in this industry for nearly 40 years, when you see the big majors selling assets and they're being picked up cheaply by the smaller companies, it's usually an indication that the commodity cycle has changed, and the cycle in relation to the resources sector has also got more upside than downside.
So, because it was going to lead to my next question, and I want to get the view of everyone on this, are we likely, do you think, to see consolidation really marking perhaps even the first half of 2015, an inevitable realisation that we're not going back to the good old days, and survivability will come down to mergers between hitherto rivals? Charles, to you first. How far along that pathway do you think we'll get through the first half of this coming year?
We're seeing, particularly in the small cap resources, M&A to be relevant, and I think the one example of that is the acquisition by Dore of Mutiny. That's clearly let's merge two companies so that you are more relevant and in this marketplace. You're also seeing M&A where it is cheaper to acquire companies with a resource than it is to go out and spend money on exploration. And we saw Centamin acquire Ampella, and we saw B2 Gold acquire Papillon. So again, that's examples of consolidation. Unfortunately, what it means is that people would rather use their paper or cash to acquire resources than put money into the ground, which means the mining services companies continue to struggle. So just
those last 2 points, paper or cash, I'm just running with a script. What the trend's going to look like now, we've got a new component, perhaps a resurgent China on this market, care of the FTA, and if they are looking to entice, beaten down players in the resource sector, never mind into ag, what's the approach likely to be composed of, given the trends there? given the market expectations? Tony?
I think you will see a lot of Chinese interest in resources next year. Now, we've probably been able to say that this time of the year for the past 10 years, but I think it'll be quite active next year for a couple of reasons. I think people do feel that the buying time where companies are cheap isn't going to last forever, that at some stage prices will rise. We've also had, as you mentioned, we've had the free trade agreement signed up, and that will come into effect. We've also had, at the Chinese end, relaxing of some of their outbound investment approvals. All of that adds up to a very busy and active year from Chinese buyers, likely to be cash. We've seen some of it this year. I think we'll see more of it next year.
Simon?
Do you think, Tony, that there's more familiarity with the way Chinese do transactions? Is that going to make it easier? Because that's been quite an inhibiting factor, and Panost in particular is coming, is battling against that.
Look, at a general level, I think it's fair to say that there is familiarity, and that's at both sides of the equations, both up in China and from people down here doing deals with Chinese companies, and that helps. It's been a few years now. There's experience both ends how to deal with those issues. There'll always be a few issues of difference, but I think those gaps are closing.
It's good to get John's perspective on looking in the other direction, going from here to there. So from Australia to China, John, care of now this newly inked FTA. The chat has been to really capitalise on it. You're going to have to shift operations, say, from downtown Shanghai to this free trade financial zone that's been kind of set up but hasn't exactly taken Shanghai by storm. Are you minded, I mean, from your soundings, from your visits even, what's your assessment of that location as some kind of a draw that China would have people decamp? Strategically, does that work?
Well, it's very interesting that the one sector that's been singled out for increased freedom to invest in that area is the lawyers and the professional services firms. So Tony and his colleagues will be looking very hard at that, and I think Tony can comment, but my guess is that the professional services firms will move very strongly into that zone. Outside the professional services area, it's not quite as easy to see people moving into China, investing. There are still, of course, foreign ownership restrictions in many sectors of the Chinese economy. Not all of them have been relaxed, but the professional services one, I think, is the one I'd look to first.
Tony, perhaps, given that's kind of been lobbed your way, let's get your response on it, and then I'm going to get your predictions up as well, because they do warrant some analysis. But just on that point, for shifting operations, practicalities, does this agreement actually make life easier, or it actually complicates your existing presence there?
Certainly doesn't complicate it, makes it easier. We've had a long presence there, but I think everyone is looking at it quite closely to see, does this enable us to get a footprint there and to get over there and invest more? So there's some detail to be worked out, but I agree with John, it's certainly one of the sectors, and it's an interesting one, but one of the sectors to watch in that area.
On now the future, and we can animate this for you wherever you're watching from, the predictions from Tony's perspective, from Herbert Smith Freehills, into next year now. Let's just bring them up if we can. Talk to this if you could, Tony, as they come up. Just a quick summary, from what we're seeing there.
Sure. So we see an active year ahead. A number of reasons for that. We've called out some particular sectors where we think there'll be activity, so property, resources, financial services as well, stuff in play there. We see some very important regulatory developments. We've talked about China, that will drive M&A growth. We've also seen here some very interesting developments, as Simon was saying earlier, about competition and a pathway directly to the competition tribunal, which will make some domestic deals a little more interesting with that particular thing in mind. There are some deal technology things we've called out as well. We don't think there'll be too much M&A law reform. There are some topics at the edges, but all in all, you put all of that together, and we're optimistic by nature, but we see a busy year next year.
You're being clever. Simon, perhaps, given that we have had you on week after week, just some final thoughts to conclude this on, because we are pretty much out of time.
Carson, it's been an exciting year. There's been plenty of interesting deals to talk about. There have been plenty of novelties. There's been plenty of growth. But that's the nature of what we look for. Ultimately, there's a serious, it's not a game, M&A. There's a serious component to it. There's serious motivations for it. And there's very serious implications across all stakeholders.
And well, not least of all for shareholders.
And I think in Australia we can... it works. It fundamentally works. The structures are sound. The institutions are sound, and that facilitates future M&A activity.
It's just a shame, as you were saying near the start, that there's this drag on sign-off, though. Notably, getting the deal done and dusted by X date seems to be shifting sands, but that's just life. That's life, Joe. Listen, thank you so much. Appreciate it. All of you on the panel today. Tony Damian, partner at Herbert Smith Freehills, here with us in Sydney, in our Sydney CBD studio. We were joined, of course, by John O'Sullivan, the chairman of Credit Suisse in the West, from Perth. From Argonaut, the very esteemed chair there, Charles Fear. Charles, thanking you as always for coming on too, and to you, Simon, goes without saying. We look forward to seeing you in 2015. And do join us then. Thanks indeed for your company.